Learning to recognize key turning points in markets is one of the most important lessons any trader can learn. Learn to recognize major reversal chart patterns. Stocks and markets rarely reverse without providing important warning signs. It's basically impossible for most individual traders to trade the news, which for the most part is old information by the time it's published. When everyone who is going to buy has bought the rally, who's left to buy more shares? Without more buyers, there is only one direction markets can go, and that's down. Know the key differences between bull and bear markets rallies. Buying the dips in a true bull market can work very well. Buying dips during a bear rally will wipe you out. Learn to recognize the market leaders. Apple started leading the market higher in 2008, well before the rest of the market followed. Those who recognized this made a lot of money. During the rally in 2004, Google was a huge market leader that made me a lot of money. In every rally, there are market leaders and laggards. Stocks making the greatest gains lead the market. When they stop leading, it's time for caution, as leaders often falter ahead of the pack when the rally is weakening. Never ignore the Fed. What the Fed does and how it is stimulating the economy has a huge effect on stocks. First, Fed supports stock prices during periods of economic uncertainty and ahead of presidential elections. Know what sectors are moving. Bond prices are usually the first to get hammered when interest rates start rising, which means it's only a matter of time before the stock market rally comes to an end. Which sectors are leading speaks volumes about where we are in the economic cycle. If stocks that have been lagging the market take off and the dogs grow wings, or defensive sectors like utilities are strongest, be careful. Goldman Sachs performed very well in 2009, jumping more than 200% thanks to the Fed's QE programs. Pay attention to volume. When the market has been moving up on falling volume, it's a warning sign. The same holds true when stocks fall on rising volume, which usually means that the number of sellers is increasing. Selling will continue until selling volume peaks, which is called a capitulation. Falling volume during a bear market is actually bullish. I concentrate on volume in big sharp upside moves. Volume is the fuel that all rallies need to last. Rising volume in a rally is bullish. In a correction, falling volume is usually bullish. Watch market breadth. Never get attached to a belief or opinion. Funny thing about emotion. Once you find it creeping into your trading, big losses will eventually follow. I love trading stocks, but I learned long ago to never get attached to a belief or fall in love with a stock. I did that once and it cost me a bundle. Once you believe that markets can't go down, they will do exactly that. When you make a trade, it is based on where your evidence tells you a stock is headed. Don't stay in a trade if it does not. Experience is what separates the novices from the experts in this business.